Hello and welcome to another Impact interview. I'm very pleased to have with me today new Business Director of Kensington Mortgages, Craig McKinlay. Welcome, Craig.
Thank you for having me.
You're welcome. Great to have you on board here, and we've got a really good relationship with Kensington. So I just want to chuck a few questions at you today, please. First of all, mortgage lending this year, where do you think it's going to be? There's quite a few different reports out. It's going to be quite static, maybe even less than 2019. What's your views?
I think it'll be relatively flat. I think we've certainly seen the year start really strongly. So I think that will continue for a couple of months. I think there's a bit of pent-up demand that with the election and a little bit of Brexit certainty's helped. The second half of the year I'm not so sure about, because I think potentially we may end up back where we were last year. So if we get to the second half of the year, is there going to be a deal? Is there not going to be a deal? All that kind of stuff. So it may slow down a bit, but I think the first few months will be pretty strong. You've also got a lot of people tied into 5-year deals now, so potentially the remortgage market might be a bit tougher.
Sure.
So I don't think anything will be huge, but I think what's probably interesting is that although the total market's quite flat, I think there's lots of different movements in different areas below that you can't see if you just look at the total.
Okay, and obviously we've had Brexit, the start of it. We've had the election finally, so we're well on our way to actually getting things done. What's the views on the markets? You've done a securitisation recently. Is it good? Is it affluent? Is there a lot of appetite out there, Matt, at the moment?
Huge appetite. So we've just done, I think it was about £600 million securitisation. I think we went in and asked for 400. It was oversubscribed by 12 times. So there's a huge amount of institutional demand for retail-backed mortgage securities in the UK at the moment, which has been really good. We've got a very good rate. Swap rates have come down. There's a suggestion that interest rates might fall, which they haven't done yet. But that's been really helpful. So funding costs are really good for us at the moment.
Sure. And do you think this year, we've heard that there are a lot of banking licenses in with the FCA. Are we going to see new lenders this year? Are we going to see consolidation? Are we going to see exits?
I think we'll see all three.
Really?
I think there's going to be, I'm told there's going to be 4 or 5 new lenders. There's quite a few fintechs coming in. We've seen with people like Habito where potentially people are brokers that are becoming lenders. So I think there's definitely some people coming into the market, but we also saw 2 or 3 quite big levers last year, people like Tesco, Sainsbury's, Secure Trust. Yeah. I think we'll see that again because margins are really tight, especially in the kind of high street where you're competing with people like the big banks who've got really cheap funding. So that's quite a tough market. And I do think we'll see some of the smaller specialists potentially consolidate. So I think we'll see lots of movement in the market this year as people struggle with lots of, there's lots of demand for people who want to do lots of lending, but margins are very thin. And actually the market, as we've said, is relatively flat. So sure. I think there'll be quite a bit of movement this year.
Okay, and with that in mind, we're also seeing some of the high streets now doing some of the stuff that you predominantly do with CCJs and defaults. And why is that? Is it going to continue? Are they going to get cold feet and come back out of the market, or are they just desperate for business at the moment?
I think they're more desperate for margin rather than business. Okay. So if you look at the high street margins, if you're selling a mortgage for 1.2%, there's not much margin there when you are taking on risk. So we've seen some of the big high street names move into our space. We don't really do much adverse. We're a very good self-employed lender. That's kind of what we mostly write. And we've seen Halifax, you see them kind of move the credit score up and down, and the same as NatWest. So that we compete a lot with those guys. But they do tend to move their criteria a lot, and like I say, because they're credit score lenders, they do change the credit score frequently. Yeah.
And what do you think we're going to see the real movement this year? The gaps in the marketplace, maybe innovation in products. What's your views on those sort of scenarios?
I think the challenge really for brokers is to keep abreast of which parts of the market are moving quickly. So if you look at limited company buy-to-lets, that's still going from strength to strength. I think there's more and more people getting tax advice that it's a sensible thing for them to do. So that's growing really quickly. So I'd advise brokers to make sure you're all over that market, or if you feel it's a little bit specialist or you're not confident, you work with a packager like Impact who can help you with that. So I think that's an example of a good part of the market that's moving really quickly, HMOs and MUBs. So although buy-to-let, I think, is actually declining, there's some bits of buy-to-let which are moving really quickly and growing fast. So I think for brokers, it's understanding that. And if you look at very vanilla lending, that's kind of in decline. But if you look at specialist lending, so most of the specialist lenders are up in a flat market, up substantially. We'll be up another 25% at least this year. We were last year, and that's in a flat market because in terms of where we play, there's more and more self-employed people. There's more and more people with 2 or 3 incomes now. A classic would be a nurse. You think what could be simpler than a nurse's pay slip, but then actually you find out the nurse has got 3 incomes because they've got the bank income, which is a second income. They've maybe got income from working with the locum on a Saturday, and that's 3 incomes. Now we'll take 100% of that, but a lot of high street lenders just automatically won't take 100% of 3 incomes. So I think the demographics are very much moving in our favour. So I think the key thing for brokers is to understand which are the bits of the market that are moving quickly.
Sure. And you mentioned buy-to-let earlier. Have we seen the end of the small landlord, or are we just going to see professional landlords moving forward? Because you hear all the stories that the one property inherited, etc., is being sold. That's not really their game, but the professional landlords in this market are going, thanks very much, this is great.
Well, we're definitely seeing a lot more activity from professionals, but I do think there's very much a place for the kind of amateur landlord. I mean, if you look at it as an investment class, people are very disconnected from pensions. So a lot of people don't trust them, they don't understand them.
Sure.
Whereas people like the idea of, I can get a buy-to-let, I can be sort of, half a mile away, I can go and see it, I can look the tenants in the eye, I can see what's happening with my investment. Whereas I think there's generally a lack of faith in pensions, some other investments. The other big attraction, of course, with a buy-to-let is it's a leveraged investment. So, you put £50,000 in, and rather than spending £50,000 in your pension towards £50,000 worth of stocks, you can get a £200,000 mortgage, or, in the case of Kensington, we'll lend up to 85% loan to value. So you really get that leveraged impact. And if house prices go up, and you get a decent yield, it's still, I think, a very attractive return, even for an amateur landlord.
And are you seeing a north-south divide?
We're certainly seeing, in terms of LTVs, if you want that kind of 85% LTV, you do need a good yield, which tends to be in the north. London and the southeast tends to struggle more. Although actually our buy-to-let business, we're doing a lot in the southeast at the moment.
Okay.
But typically the high yield does tend to be in the north.
Okay. What about HMOs? Is that more southern based?
Yes, more southern based, and again, I think it's people looking for yield. So, where potentially stress rates are harder in the south, you can get a very attractive yield with an HMO or a MUB. And again, some brokers feel less confident in that. So a specialist packager like Impact can really help with those kind of products.
Appreciate that. And I think round this way, it's a lot more fashionable for someone to actually rent a room rather than going back to living with mum and dad after they've been to uni for 4 years and so on and so on. So I think we're seeing that on the increase. Technology is playing a big part. 2019 was supposed to be the year of technology. So was 2018 and 2017, but we're now into 2020. What are you spending your money on? What's going to work in 2020? What's the ambition?
Well, it's a huge focus for us. And the way we're approaching it is very much, we're committed to keeping human manual underwriting, because it's the underwriters that can deal with the complexity. So deal with 3 incomes, deal with self-employed, company accounts, limited company portfolios.
Yeah.
The computer algorithm can't do that, which is why the high street struggle, and some of the new digital brokers struggle with that, and people like robo-advice just doesn't work. So we're committed to having a human manual underwriter, but what we want to do is digitize the process up to that person. So we've got things like Mortgage Apply with 27 Tech, and obviously we get a lot of business through OMS. So digitize it up to the underwriter, digitize the back office. So, and a good example of that would be our focus on service. So we've had a very successful couple of years. We've pretty much doubled in size in the last just over 2.5 years. And last year we halved our app to offer. So the brokers know that when lenders get busy, service tends to get worse, especially when they get very busy. And what we've managed to do is we've had sales have gone up and up and up, but our app to offers come down. So we halved our app to offer in 2019 versus 2018. We're at 12 days at the moment. We're on a 1-day turnaround. And a lot of that is the technology we've deployed so that the underwriter can spend their time underwriting. So an example would be we've got 4 sets of robotics. So the robot will do low value added services. So it will do things like check the solicitor's register to make sure the solicitor that the customer chooses is still registered. It will do land registry checks so that the underwriter isn't wasting their time doing all that. The computer does all that for them. The underwriter spends all their time in the real weeds of the case trying to find a way to make the case work, which means they can do more business and we can improve our turnaround. So our approach is very much, we want to give brokers the best of both worlds. We want to give them the high street speeds and service. So we'd like to get down to 5 days apt to offer in the next year. We've got an aspiration to get down to 1 day, but still keep that manual underwriter that can deal with all the complexity.
Okay. And the SCA recently came out with their views on execution only with regards to technology and so on. What's your views, Kensington views on that scenario, effectively taking the advisor out of the process?
It's just not something we are interested in. I think maybe for a very savvy, maybe a remortgage customer that's done this several times in the past and thinks they can find the best rate through, maybe some of the aggregators might be interested in that. But if you look at the Intermediary Lenders Association, they released their latest statistical release last week, and the amount of customers using a broker is 76% now, so this is the highest it's ever been. Yeah. So consumers are going the other way. The mortgage market's getting more complex. The opportunities and challenges with mortgages are getting more complex. So people need advice more than ever. And as their personal circumstances get more complex, they really need advice. And if you look at buy-to-let, it was 92% of clients went to a broker last year for a buy-to-let mortgage. So I don't think it's anything we're worrying about. I think, and potentially it could only really do the really simple high street cases, the remortgage cases where you've got, husband and wife, 2 P60s, but the kind of market we deal with, which is where you've got complex circumstances, I think we're a long way off that. It's not something we're worried about. We're very committed to keeping our manual underwriting and working with brokers.
Okay. And product transfers is a £160 billion market last year, apparently. Is that not something that a broker should be worried about by putting their clients with a PT for 5 years and then A, it's a smaller income, but B, you're not seeing the client for the next 5 years? And what if the high streets then wanted to actually take that internally?
Absolutely, and that's what we see. We see a lot of the high street lenders just start taking customers direct, so a broker introduces them and then the high street lenders will go direct to them and try and pull them direct. And if you look at it, I think the PT market was about 180 billion last year, so it was twice the size of the remortgage market, and I think that should be a cause of concern, because is it always right for the customer to stay with the same lender? Now obviously it's very easy, and there's certainly a premium customers will pay for that ease and the certainty, but I think there's a lot of options out there, and we need to make sure that customers don't just kind of get hooked on that, I'll just stay with the same lender because it's easy, when potentially it could cost them several £1,000s if they are doing it direct. If they're doing it execution only, do they really understand what they're getting into? People's circumstances do change. A 5-year PT, a lot can happen in 5 years. Do consumers really understand that when they tick that box, send the form back, and they're on to another 5-year term?
Sure. Where do you see rates this year?
I think interest rates will stay flat. There's potentially, if the economy does badly, they could be dropped, but personally I don't really see the point. You go from 75 to 50 basis points as Bank of England base rate. Does it make any difference? Not really, they're already so low. So I think they'll stay fairly flat. I think swap rates are more interesting. I think some lenders we've seen exit the market because they can't make the yield, so that could push rates up a little bit. But I think it will still be a great consumer story where rates stay pretty competitive.
Okay. Time has run away with us. Just finally, where quality is key in the current climates, where do you see Kensington being better than the rest at the moment?
Well, I think our service definitely stands out. So the fact we are 12 days apt to offer at the moment with a 1-day turnaround, and that will continue to fall this year. We're trying to get down to 5 days. I think that makes us stand out. Our approach to customers, we've got things like our Heroes mortgage range. We've got some really big news with a couple of new propositions in the next couple of weeks. I think we're quite different to other specialists. And I think our rates, we've got rates from 194, which for a specialist is pretty cheap for residential, and 2.4 for buy-to-let. So, sure. Specialist doesn't have to be expensive.
Okay. And anything else you want to say to our audience?
Just thank you for your continued support. We've had a fantastic year with brokers over the last couple of years. great support from Impact. You know, we're only really starting the journey. There's so much more we can do in improving the service and coming up with some really innovative products, which, like I say, we've got some good news in the next few weeks on that.
Brilliant, we'll look forward to it. In the meantime, any questions or inquiries, please give Impact a call. The numbers and things will come up on the screen shortly. If you want to see some other previous video interviews, again, have a look at our YouTube channel, that'll be on the screen shortly. Thank you for watching this. Tune in next time and hopefully you'll have found that of value to you. Many thanks.